If you're a first-time business buyer and you're interested in or actively pursuing buying an accounting company, you need to know this one. It's the biggest rule in accounting acquisition. So you need to know this issue. You need to know how to analyze it, and preferably, obviously you're going to hire a competent M&A law firm like us to do your acquisition for you and do this analysis for you. But it's so important that the buyers themselves, you even need to know. So I'm going to tell you really quickly, first of all, who am I? And then I'm going to walk you through this rule. So first of all, I'm Joe Principe. I can pull open the deck here. I'm Joe Principe. I'm representing right now a large international accounting firm doing roll-ups of accounting firms across the United States. I've worked on over $100 billion in transactions. I used to work at Freshfields, the leader of the Magic Circle of International Law Firms, the #1 international M&A law firm by quality in the world. I worked at other law firms, big top law firms like Baker McKenzie, Morgan Lewis Bockius. I clerked at the U.S. Securities and Exchange Commission. I run the #1 first-time business buyer M&A law firm in the U.S. And if you need a lawyer because you're buying a business, then you can get onboarded with us at Principe.com. We have an intake process on there. So I'm going to get straight to the content here. So this is the biggest issue, is there's this requirement around whether or not the target is a CPA firm or a vanilla accounting firm. And this is a very important distinction. A lot of people, even lawyers, get this wrong. They think, oh, well, they have CPA in the name, so it's a CPA firm. That's not the rule. Or, oh, they are licensed CPAs and therefore it's a CPA firm. That's not the issue as well. It's much more complex than that, and I'm going to walk you through it though in really simple and concrete detail, and this is only going to take a couple minutes. So the issue is that as outlined in my deck here, right, is that true CPA firms must be controlled by CPAs. So if you're trying to buy a business and you or some of your investor partners aren't CPAs, well, that obviously can be a problem, right? But there's a way to structure around that, which I'm also going to briefly go over here. I'm just going to go over the rule first. The rule is that around 48 out of the 50 states hold that the majority of the owners of a CPA firm must be licensed CPAs. In 50 out of 50 states, the firm must be controlled by CPAs. And around 15 out of 50 states, the owners must be natural individuals, so you can't have an investment partnership or an investment fund acquire the CPA firm. This includes California, for example, where it makes things more complex, but we're going to go over how to handle that. But it excludes, major M&A states like New York, Florida, and Texas. And lastly, in about 45 out of 50 states, the non-CPA owners, so even though a majority of the owners needs to be CPAs, the non-CPA owners still need to be active investors. You can't just be a passive investor, which is obviously a huge restriction if you're not a CPA or you don't want to be working at the CPA firm actively as an employee, but you still want to acquire one or more accounting businesses. So that's the law. Now let's talk a little bit on the next slide about how we analyze this. Okay. First of all, we have to ask ourselves, is it even a true CPA firm? And there's a few different questions we have to ask to analyze that. I'm going to walk you through these questions here. As I kind of set out on the slide, but I'm going to talk it through verbally. I'm not going to read through the slide. As I set out there, if it is a true CPA firm, then you need to do a certain type of structure, which we're going to outline next. And if it's not, you get to do the simplest, easy version of a structure, which is what you're going to be hoping for most likely if you're a first-time business buyer. Anyways, and so here's the questions you need to ask. You need to ask, does the target only perform non-CPA work? The definition of CPA work is obviously going to be set out in the statutes of every state, but just generally, non-CPA work includes bookkeeping, tax filing, tax strategy, tax planning, fractional CFO work, etc. So if you're just acquiring a bookkeeping business, but it's set up as a CPA corporation, interesting. What do you do then, Joe? They don't do CPA work. I'm not buying a CPA business, but the owner set it up as a CPA firm. Let's look on the next question. Does the target hold itself out as a CPA firm? Because, for example, the owner is a CPA In that case as well, you're acquiring a CPA firm, or the target needs to stop holding itself out as a CPA firm post-closing. So as you can see here, we're trying to see what bucket you're in, and there's different ways to get out of the CPA firm bucket. Moving on to the next one, is the target structured as just a normal LLC, for example? Or is it structured as, for example, a California professional corporation, which is essentially the CPA version of a corporation in California in this context, right? So if the target is set up as a CPA firm, but it's only doing bookkeeping work and they're holding themselves out as a CPA firm, what do you do? That's really complicated. Well, in the best case scenario, which again, you have to, analyze every single case differently. In the best case scenario, you can have the firm stop holding itself out as a CPA firm, keep just doing the non-CPA bookkeeping work, and restructure it to not be a professional corporation as of closing. And then all you're doing is acquiring a non-CPA firm, which is way simpler than acquiring a CPA firm. You can't, however, do that in all circumstances. And there's different ways to handle that. But so I know I speak fast and legal stuff is really complicated, but I'm not trying to make this a 30-minute video. I got business to get to, right? And so now what do you do if it's a CPA firm or a non-CPA firm? How are these deals structured? How are the big boys? How are the private equity firms doing these deals? So I'm going to really quickly go over that. Obviously, I'm not trying to teach a legal class here, and I'm just trying to give you some general, guidelines to set up a framework for if you're interested in or are acquiring an accounting business. So in structure number one, where it's not a CPA firm, you're just going to do a normal stock purchase. It's very clean. It's very simple. It's very quick. You buy, maybe if it's just you as an individual or if you have some investors, your entity, you individually or your entity buys the stock of the target accounting firm. Very simple. If it's a CPA firm, meaning they do some CPA licensed work, for example, then you have to do structure number two. Obviously, when I say you have to do, what I mean to say is that that's what everybody's doing. There's an infinite number of ways you could do this if you want to get technical, but this is what you're supposed to do. So what you do is you do an asset purchase plus what's called an MSO. So I'm going to walk you through it briefly. Again, this is not a legal course. So you're going to set up another entity. Your lawyer's going to, right? It's called a management services organization. That's not the type of entity. That's the type of service it's going to provide, okay? And so that management services organization enters into a purchase agreement for certain assets from the CPA firm. What you're going to do is you're going to buy everything from the CPA firm that isn't the thing that performs the CPA work. So for example, if there's a CPA at that firm that does auditing services, well, you're not going to acquire him as an employee. You're going to leave him there. But you're going to buy the lease, the place he sits in. You're going to buy all the office equipment he uses. You're going to buy the systems and infrastructure he uses. You're going to buy any, brand IP, as long as the word CPA isn't in the brand. You're going to buy all the IP he uses and brand he uses. You're going to buy the customer list to the extent you can that's he's using. And you're going to put all that stuff into your MSO entity. And your MSO entity is going to enter into a management services agreement with that CPA firm. And the guy is going to be sitting there still doing the CPA work, but he's paying you money now moving forward for that CPA work, okay? So that's how you're not, because you can't control, if you're, like I said earlier, there are these control restrictions on a CPA firm. So what you do is you set up this other entity that really owns everything besides the real necessary CPA tidbits. And then, you're providing services to that CPA guy, and he, he's paying you. So you basically acquired the cash flow of the CPA business, or let's just say legally a material amount of cash flow. And what you've done is you've acquired all the non-CPA assets of the business as well. So say like 10% of the target was CPA work. Well, you bought 90% of the business, right? Anyways, so that there were no restrictions on doing that under your asset purchase, and you're just running with that moving forward. But as for the 10%, you're going to leave that there, obviously, with the seller entity. And there's different ways you could do this. You could have multiple entities set up, etc. But that's just a very brief overview to kind of give you a structure in your mind as to how this works. And so if you are going to acquire a accounting firm, You need a law firm, and so go ahead and reach out to us at principe.com. We have our automated intake set up there. Go through that system. It's really important. And don't just email or give me a call directly. Thanks.